Hi, I'm Mr. Gilius, the tax lady from EG Tax, and we're here to talk taxes. And in the news, everybody's talking about Trump's big, beautiful bill. And I'm going to tell you that means there's big, beautiful things in it for you. And depending upon what side of the aisle you're on, you might say that how they're going to pay for it, and that's a concern of mine. But it's interesting. I read an article this week that said that Trump thinks that you shouldn't pay taxes if your income's under 150,000. So that's really interesting. He has really shook up the status quo. Anyway, I'm Esther Gillies, the tax lady from EG Tax, and we're going to be talking taxes. We're not taking your phone calls. We're doing emails today, and I got Chris Fabian in studio with me. Hey, Chris.
Hello, Esther.
Hello, Christopher. So here it is, smack dab in the middle of summer, and there's big changes in tax law, and we're going to talk about that as we go along, because there's going to be some modification, and until it's absolutely signed into law, we won't know exactly all the details. And I bet you there's a lot of things in there that nobody's been reporting on.
Oh, I'm sure, because that just like Obamacare, and when that got passed, how things changed. When the infrastructure bill was trying to get passed, there was so much stuff tucked in there that nobody talked about. I don't think anybody knew about.
Right. Well, this is a 1,000-page bill, so yeah. Believe me, there's stuff. But anyway, why don't we go to some of our emails? And by the way, during the week, like let's say over the holidays, all the wonderful holidays that we have in the summer, how we love Western New York. It's so great in the summer. I know it's been hot, but anyway, when you're talking among your friends, you can go to egtax.com, ask the tax lady, type in a question, and I'll answer it.
Yeah, you will.
So do it.
Yes.
Especially now that, you might be saying, I heard overtime is not going to be taxed. That's full of baloney. Well, be very happy to help you.
Yep.
I mean, it is remarkable.
Oh, yes.
Some of the stuff is like, how can this not be taxable? But we sure want to help you.
Exactly.
This year is a transition year, so I think people will be learning what's in the law for them and all the things that they can do because of the reduction of tax liability that can save them money. It's an interesting thing. People that have done Roth conversions, how many times do we tell them not to do a Roth conversion?
Oh, yeah.
Don't go from traditional to a Roth, because who knows if they're going to change the tax law. Hello?
Yeah, yeah.
So these people that have paid all that money
might have to pay again,
but I mean, because of the way that some of the stuff is parsing out, they may have paid taxes because they thought they were going to be in such a high tax bracket, and they found out that their standard deduction is sky high, and they're going to get an extra exemption for this, that, and the other thing, and so they really paid taxes that they shouldn't have.
Right. Right.
Anyway, well, let's see what we got here, Chris.
Well, here we go. Shelley writes in, do you think if they change the taxability of Social Security now would be a great time to do a Roth conversion?
Oh, my gosh. I didn't even know you had that there.
Yeah.
Okay, so with the increased standard deduction, with the increased, especially if you're a senior, it would the extra deduction they're going to give you for being over 65. You have all of these deductions that you never had before. So in essence, you could take out of your IRA and roll it into a Roth and maybe not pay taxes at all.
Right.
Because you have so many deductions that you never had before.
Yeah, if you're single, especially if you're married, the standard deduction and you're both on Social Security,
right.
With what the House is saying and what the Senate is saying, it could be an extra $4,000 to $6,000.
$6,000, yeah.
And
so that's $12,000 a couple.
Yeah.
Plus the increased standard deduction. So you figure maybe $15,000 could be taken out tax-free. And that's the thing, what we're going to do in the fall, we're going to have seminars, free seminars, to show people what they can do to maximize all of these changes that are coming down the pike.
Right. Yep.
Right?
Definitely.
So the short answer is maybe, because it all depends on your income.
Right. Depends on your income, your tax
And your
bracket.
age.
Yep. Definitely. Yes. And then here with Miriam writes in too with the thing about Social Security. I just started collecting Social Security last January. I get approximately $2,500 per month. My husband also collects, and his monthly is nearly $2,800. We are both 68, and he works full time. He makes $35,000 as a part-time person. Okay. Our investments annually are close to $5,000 in interest. If they pass the big tax bill, how does that affect us?
Okay, so the big thing is that their income, they have $53,000 a month from Social Security, so almost $64,000 in Social Security income. All right, which is going to be 85% taxable, but they're going to end up with, which would have been the case last year, but they're going to end up with a deduction anywhere from $8,000 to $12,000, and so, assuming they're in the 12% tax bracket, they would save about $1,440 in taxes. So that's good.
Right. So if they had 15 or the 22% in withholding, they might, bring it down to even the 10%.
Right. And so, and that's the key is that, here's the other thing that I think maybe they're missing, because he's working and making $35,000, they could both do IRAs as well.
Yeah, there you go. Definitely.
So they got the deductibility under the big beautiful bill of anywhere from $8,000 to $12,000. They have the IRA that they can put money into. It looks like they have money to invest because they're getting $5,000
in interest.
In interest. So if they were to put that money into an IRA, plus with the extra deduction they're going to get for being over 65 in the big beautiful bill, they're going to have like $20,000 that's not taxable this year, and so that'll save them about $2,400 in taxes. So, and you'd have till April the 15th next year to put the money in.
Right, and that.
So yes, there's good things coming down the
right,
pipe.
and you mentioned the seminar coming up, but that's not the only time you can come in and talk to us about tax planning. We're there all year, and that's what we help people with, is doing the tax planning, knowing how things are going to impact you and what your withholding should be, and should you take Social Security now, or should you wait till it grows? That's a big question too. A lot of people have. Right.
That, and we all know how I feel about that. I mean, if you're still working and you're under the age of 66, regular and normal retirement age, and you're collecting socials, and you are thinking about collecting Social Security, but you're thinking about keeping it till 70, so you get that extra money. The extra money you're getting is the money you didn't take.
Right.
And until you get to age 83, you don't break out even. So, and at 83, I don't think you're probably going on a big world cruise. So you're going to use it for a nursing home. So, I mean, while you're young, I think you should take the money.
Exactly.
And anyway, Social Security is having big problems.
Yes.
Anyway, I'm Esther Gilius, the tax lady from EG Tax. I'm with Christopher Fabian. We're doing emails today. I know a couple weeks ago, we had somebody said, I would like you to ask my question on air. And so we love doing that. So we're going to take a short break. We'll be back on the other side. Hi, I'm Esther Gilius, the tax lady from EG Tax, here in studio with Christopher Fabian. Tiffany's got the day off, and we're doing emails this week, so don't call in. But next week you can call in, but not this week. And we're talking about all kinds of questions. And during the week, if you do have questions, you can call us and like people talk to you at our office. We actually communicate. Or you can do it the new fashioned way. Go to our website at egtax.com, ask the tax lady, and I'll answer your tax questions anytime you want.
A real person will answer your tax question,
Right,
not
a real
AI.
person, not an AI. Yeah, that's for sure.
It's so funny. I had
What do
somebody.
you think about that, Chris?
I don't like that at all. I had somebody in the office last week, and we got talking, and she's like, I hate calling someplace, and all you do is get a robot. You get this AI stuff, and pretty soon, I'm sure my financial person will be AI and all this other stuff. She goes, I want human contact.
That's true. That's true. And an oh well. I mean, an AI, at the end when you're reading it, like for instance, you go to Chat GPT, it'll say, and by the way, contact your financial planner or tax advisor because we really don't know if we gave you the right answer.
Right. And even with Google, when you Google something now, the first thing that pops up is the AI answer, not the usual Google search.
Yep. That's
so it's
true.
very
okay,
interesting.
And we got to talk taxes.
We'll talk taxes, yes.
All right.
Okay.
So what do we got as far as another
email?
Text.
Okay,
email.
so Tony writes in. Tony, I'm a server at a well-known restaurant locally. I pretty much live off my tips, which come to $50,000 or more a year, plus my base salary of $22,500. Just how will the no tax on tips affect me?
Well, you're going to save money, Tony. I mean, there's going to be a cap on the amount that's going to be written off. I think it's about like $25,000. So you're going to basically, and how do you feel about that, Chris?
Well,
I mean, what do you think about somebody? Okay, he's working for tips. He's making $72,000 a year, or plus, and it's not that I don't like Tony, because I like Tony really a lot. But the truth is, I have to pay taxes on every dollar I make.
Yep, definitely.
And so if he gets off with the $25,000, right, and he's going to save taxes around $3,000, which is great. But it's almost like when they came up with this, that they thought, well, people that make tips only make about $8,000 or $7,000 a year, but that's not true. If you're working at a high-end restaurant, you're doing really well.
Oh gosh, yes, yeah. I mean, if you work in the restaurants, not just in Buffalo, but across the country, in Chicago, New York City, L.A., where these high-end people live and they tip extraordinary, I'm sure there's a lot of servers who are like Tony, where it's 75% is tip income.
Yep. So yes, Tony, and by the way, this is like for the first 3 years after this is signed into effect. So enjoy it while you can. But yeah, you're going to end up with a deduction that you never had before. So yay for Tony. Now do something smart though. Take that money that you're not paying in taxes and put it into an IRA or a pension plan.
Right, save for your future.
Because that'll even save you more money.
Right, and the good thing is, he may not think it's good. I think it's good. They still have to pay into Social Security and Medicare on their full tips.
Right.
So
that's good. I mean, that's good, because if he's going to live to collect Social Security, God willing that there'll be some, you're gonna be glad that you did that. And your employer, of course, is going to do the half match. But do yourself some. You probably have thought to yourself, well, I'm just a server, so I don't have to tax plan. Now you should, because you have an opportunity to save like $3,000 in taxes. Take that savings and do something with it.
Yes. Definitely.
Because if you're not planning on dying, you're going to get old, and when you get old, you're going to be glad you have some money set aside.
Right, yes.
So, well, that was a good question. Okay, what else we got?
Okay. Robert writes in, my son started a landscaping company this May. To date, he's brought in around $20,000, but he had to purchase a lot of equipment. I loaned him the startup cash to buy his larger equipment like mowers and edgers of $10,000. It looks like he will double the income or better. Does he need to register his business? Do I take a $10,000 loss?
Well, first of all, anytime you're making money and you're freelancing, and they call it the gig economy and all that stuff, whether it's registered or not, is it taxable, Chris?
Always.
Right. Okay. So, a couple things I think of is the kid's doing landscaping. Do you think that he should have insurance, like for liability?
Oh, yes, definitely.
So he really needs to. I know Dad and him are probably sitting over the dinner table figuring out what to do, but Dad needs to come up with a repayment plan because it's a loan to his son, right?
Yep.
Unless Dad is becoming a partner. So they have to work these things out.
Yes. Yeah, they have to get everything, and it's got to. In order for Dad to take a loss, it's got to be a legitimate loan. It has to be assigned.
Well, and that's if his son doesn't pay him back.
And exactly, yep, I was getting there. Yes.
Yeah, I'm sorry, Chris.
That's all right.
So the thing is, I think they need to have a meeting to figure out just the nature of everything. So if Dad loaned him 10,000 and it's really a loan, then he should sign it to make sure they have a repayment schedule and everything. That's number one. So it's a bona fide loan. And then the second thing is the equipment then that he bought with that borrowed money becomes an expense on his Schedule C, because it doesn't sound like they became a corporation or anything like that. The next thing I would think he should do is maybe a limited liability company. What do you think?
Yeah, protect his personal assets. If Dad gets involved, it would protect Dad's personal assets too. So
Right.
definitely a good thing.
And you might say to yourself, why would a landscaper want to do a limited liability company?
Right. Well, yeah, because there's a lot of things. I mean,
That you can ruin.
yeah, I mean, I'm just
Knock down the fence, cut the power line. I mean, you
Yeah.
know,
when I
on
was
my-
coming into the studio, there was a plumbing company, but they were digging up all the landscaping. What if they hit something that they shouldn't have hit,
Right.
and it caused big damage? Well,
right.
you
And so explain what a limited liability company does.
what it is. It's a business entity, but it gives you the insurance protection of protecting your personal assets. So your house, your car, your savings, anything you have personally is protected as long as you do everything correctly.
Right.
And that's the big thing. You have to do your books correctly. You have to, don't.
So you have to act like a business in order to
Exactly.
get the limited liability protection.
Yes.
And it's not you use the word insurance, but it's not like the kind of insurance you go buy.
Right.
You mean it's the protection.
The protection,
right, that you can do. And I'm going to tell you, if you have a small business, this is a very litigious society, and you see the commercials all day long about you got hurt, we're going to protect you. And so the federal government and actually it's the state that makes you a limited liability company. You go to the state, you fill out a form that says I'd like to be a limited liability company, and then they hold you to a higher standard, but then you have your assets protected. And I'm going to tell you, you think, how would a little landscaper guy have a problem? You could hit a rock, a blade could come off from the lawnmower and hit something or hit someone or hit a dog or whatever. I mean, there's all these things that could happen, and I would suggest that Robert, you and your son start a limited liability company, and then keep accurate books, set up the loan documentation, and at tax time you'll be happier.
Right. And then about registering your business, how about this? He better register with New York State sales tax.
Oh, hello. Forgot to mention that.
Yeah,
why would that be important, Chris?
Well, because landscaping is subject to sales tax. And if New York State catches you, they will shut you down.
Yep.
So-
And assess you a ton of money in sales tax.
Oh, yeah, they'll say, well, we think your sales are this, so you owe us
Right.
all this money.
Right.
And so then it's up to you to prove otherwise.
Yep.
So, yeah, it's
So,
not just...
And again, that's where you can come in and we'll get you all squared away so that you don't get into trouble. And because it sounds like Dad and his son are really looking forward to really starting a successful business. I know we do a lot of landscaping companies,
Yep.
and they do very well. And that's the way our society is kind of becoming. Like, I'd rather pay somebody to cut the grass than have me cut the grass. And in your situation, your daughter always gets poison ivy. So, right?
Well, yeah, when she does the weeding, not just cutting the grass, but yes.
Uh-oh, soft spot there. Anyway, I'm Esther Golias, the tax lady from EG Tax. We're going to take a short break for the news, and we'll be back on the other side with your questions. Don't forget, next week we'll be taking your phone calls again, and we should be able to really chew up that big, beautiful bill and help you. And don't forget, we're going to start doing seminars in the fall. So I'm going to take a
Hopefully
short
it's
break.
all
We'll be
passed.
back on the other side. Hi, I'm Esther Golias, the tax lady from EG Tax. We're hoping you're having a wonderful summer day in Western New York. I don't think there's anything better than summer in Western New York. I'm joined in studio with Christopher Fabian, and we're just doing emails today because it's so much fun to get into depth, I think. Right, Chris, don't you think? As opposed to we do a good job when somebody calls in, but it's like you can really talk in depth when you're looking at an email.
Oh, yeah. You can dive into it. People can hear.
And so we know that the big, beautiful tax bill is rolling along, and there's lots of changes, and we want to make sure that you're aware of everything. And so as soon as this thing is codified and it's all written, we will let you know. And but a lot of people should know that there is big changes on the horizon, and really there's something in it for everybody.
Yep, definitely,
All right?
definitely.
So what else we got here as far as our emails?
Sure. Bob writes in, Esther, I just received a deposit in my checking account for approximately $29,000 from Social Security, and now I'm going to receive $2,500 a month. I'm a retired federal worker, so is this taxable, and at what rate?
Okay, so he doesn't say if he's married.
No.
But is it a lot of times? I mean, back in the day, Social Security wasn't taxable. Now, if you're depending upon your marital status, if you're receiving Social Security and half of the Social Security, when it's added to your other forms of income, exceed $25,000 if you're single, $32,000 if you're filing a joint return, then the excess over that figure is half taxable up to 85%. So is it taxable? Yes.
Yeah.
Right?
Yep. I'm wondering, though, because he said he's a federal worker, is this one of the...
That's what it sounds like.
Yeah, one of the people that just got on Social Security because of the law change last year. So that's probably why he got the lump sum of $29,000.
Well, that's what I assumed when he said he was a federal worker, because to let everybody know that if you were a federal worker under the old system, they wouldn't let you contribute to Social Security because you had a federal pension. Something happened last January, and they said, oh, that wasn't fair. Even though these people never really contributed to it, we're going to give them all their back money. And God bless you if you got it, but really, that was a stunner.
Oh, yes. I mean, here, this person got a lot of money right, up front. And the thing is, too, because this was for 24, he got his money in 25, he can do a lump sum election to see what's better, to have it being taxed as in 25 or being received in 24 and 25.
Depending upon what his income was.
Exactly.
Right.
Exactly.
So that could save him some money. Plus, this year is going to be that the deduction for collecting Social Security, which will also save you some money if you're a senior, which obviously you are. So there's some good things. But I would suggest you call our office at 632-7886. We will ask you some questions so that we can know specifically your situation. And we'd need that 23 tax return as well.
Right. But I mean, that happens a lot. People will call us, not just on the radio, but at the office, and ask a question like that where we have to follow up with a lot more questions. Are you married?
Right.
How old are you?
Otherwise,
What's
you give them
the
wrong
other
advice.
Yep.
You know.
Yep. So, yeah, definitely give us a call, Bob, so we can answer this more specifically for you.
Cool. All right,
Yes.
what else we got?
Let's see. My mom is in a nursing facility. We are spending over $14,000 per month to keep her there. She has a lot of investments with over $1 million in stock alone. Last year, her dividends totaled $42,000, and her Social Security was $23,000. The property taxes we pay for her are around $8,000. She paid New York taxes last year of $2,000. Do we need to do estimated payments for her? Will proposed changes help her? Jay.
Wow. Okay, so wow, there's a lot of numbers here. Okay, $14,000 a month is what they're paying to the nursing home, which is a medical expense, right,
Yep.
Chris?
Definitely.
And so they're paying about $168,000 a year, which covers a lot of taxable income. So we got that $168,000 sitting out here. So there's dividends of $42,000, and her Social Security is going to be 85% taxable. So let's say $18,000 in Social Security. So her income's like 60, but 7.5% of that is 4,000 is going to come off the 168,000. So she has like 164,000 in itemized deductions plus her property taxes and the state of New York. So she's not going to pay taxes at all
Right.
because of the big medical,
Yes.
right? But what should they do on the New York return?
Well, that's what I was just calculating out to say, hey, what about 22 and 23? Did she file that IT 229, the real property tax credit? Because there's an extra $250 to $350, probably $350 for mom, but also she's private pay for the nursing home. So now you guys should be getting the refundable bed tax credit back.
Which is an IT 258, right?
Yep.
So I mean, and so you figure on 168,000, 6% is $10,080 that they'd have as a refund from New York State because of your private pay in a nursing home. And it sounds like she was in a nursing home for a number of years. So up to 3 years, you can amend her return and get that bed tax refundable. And nobody's going to tell you.
Right.
So you want to make sure it's an IT 258, and then what Chris was saying is the 229. But doesn't she make too much money for the 229?
No, there's no income limit.
You're right. Good point. How about other people that have property and don't have to file tax returns? Who else should we be talking to about this?
Regular seniors, people who are inherited a house who are money, and so they're not working anymore, but they own a house and pay property taxes.
So when somebody says, "But I don't need to file a tax return,"
well, you may
I
not.
do own a house, but I don't need to file a tax return.
Right.
So are you talking to them?
Yeah. So just because you don't need to doesn't mean you don't
want to. Right. Because they could get up to $350 back.
Yeah.
Right. And since 2000, what was it? 21 died this year, but we still have 22 and 23.
Yep.
So we're talking about doing a 2022 and 2023 a New York State tax return with the Form 229, and you could get up to $350. And if you didn't do your tax return, you're a perfect candidate if you have a house and paid property taxes.
Right. And especially those who are listening in the New York area, if you haven't filed a 23 tax return, you may want to, so you can get in on that New York inflation reduction check that's coming out.
Oh, and
in
that's
October.
the other thing. That's true.
Because if you don't file a return, you don't get that money.
Right, absolutely. So there's two things. There's the inflation reduction credit that's coming out, and they do say it's a check, and they do say that they're going to do it automatically. But here's the thing: if you don't have a tax return in there, they might miss you. And so it's maybe a good idea, just like an insurance policy, to file that return. Number one. Number two, if you're paying property taxes, when we're filing the return, we might be able to get you $350 too.
Yeah. So it could be a win-win.
Right. Win-win. Okay.
Yes.
What else we got here?
Let's see. We have my wife and I pretty much live off of our Social Security benefits. We retired in 2024 at the age of 63. We have investments in our pension and 401k plans of around $400,000. Will the tax changes to Social Security help us?
Yes, they will. Well, first of all, this couple isn't going to pay taxes, right?
Right.
But what should they do because of all of these new deductions?
Well, they probably could take out easily $25,000 a year and pay no tax, depending on how much their Social Security is.
Right, because even what people don't realize is you have this big, huge standard deduction, right? Of like, because you're over 65, like this year, like 34,000. Then on top of everything else, they're going to be giving you this additional deduction of $12,000 if we're going with the Senate version. So you're not going to pay taxes until your income gets to $46,000. So there you are sitting with all this free deduction, and you got this potentially taxable 401k plan sitting off yonder, and you think to yourself, well, I don't need to take it out because until I'm 63, I don't need to take it out. But even though you don't need to take it out, if you do take out like $25,000 or $30,000, how much is going to be taxed?
Zero. Right.
Zero. So if you took out, let's say $35,000 for the next 5 years, you get rid of $175,000 worth of what would have been taxable income in exchange for no taxable income, and then what you have left out of your investments would be about $250,000 rather than $400,000.
Right. And
so knock it off before you have to take it out.
Yeah, I understand that aspect of it, but if you're on the New York State of Health insurance, because you're only 63, you're not on Medicare yet, and you're on the essential plan, you got to be careful with that.
Well, that's a good point.
You got to be careful. Yeah, tax-wise, you can take out a lot of money tax-free, but be careful of health insurance.
But you need both. You need to look at both.
Yeah, because health insurance is a little ridiculous right now.
Sure. Okay, I'm Esther Golias, the tax lady from EG Tax. I'm with Christopher Fabian. We're here in studio and we're doing your emails. And if you should have any tax question, you can go to our website at egtax.com and ask the tax lady. We then kind of go through these emails to see what we think would be interesting to all of you guys. So anytime, just email us. We're going to take a short break. We'll be back on the other side. I'm Esther Golias, the tax lady from EG Tax. I hope you're having a wonderful Saturday. And we with all the changes in the big, beautiful bill that's just come down the pike, we want to make sure that you understand how this affects you. By and large, it's pretty much a blessing down the road for everybody from a tax standpoint. And I don't know how Trump's going to pay for this. Maybe with the tariffs, that's what he says. So it's interesting. I've never seen such a big handout in reduction of taxes as what's happening now.
Yeah,
is that?
And we lived through a lot of tax changes.
Yeah, and I think that's why I'm always so suspect when something's the law and you're talking to your financial planner and they're basing what they're trying to do 25 years down the line on current tax law. I have learned that current tax law gets changed and then it goes up, it goes down. And so making your decision that's that long term, you got to really be careful.
Yes. Yep. Definitely. You got to watch your pennies and your dimes and your nickels.
Right. Absolutely. All right. So we got any other?
Yeah.
We got our emails we're doing today.
Yep. This is
Don't call in today. Next week we're taking live phone calls.
Yeah. So this is going to sort of feed off of Milt's email, but this is Sam. I'm turning 73 next year. How does the RMD get calculated? Is there any way not to do it? Don't want to pay more taxes.
Right. And yeah, what's happening once you're a senior, your standard deduction is so big, and the deduction that because you're paying Social Security is so big that you'd be surprised how the money that you have to take out of your RMD is probably not going to be taxed anyway unless you're a fairly wealthy person. But basically, they use what's the word? Annuity table?
An
Actuarial table.
Yeah.
And basically they take a look at what your income was in your IRA, 401ks, tax sheltered pension plans, and they divide it by the number of years that you have to live based upon the actuarial table. And when you look at the actuarial table, you think, wow, I'm supposed to live to be 100. But anyway, and so the first year I think you divide it by 27.3.
Used to be. Now it's 26.6.
Okay.
Because
so
it's going up to 73.
So as of December 31st, you take a look at what's in your bucket on your IRA, and you divide it by the 26 years life expectancy, and what's left that's the minimum amount that you have to take out. But if you are a giver, there's a way around that, right,
That's
Chris?
I was going to say. To answer is there any way not to do it? The answer is no, but there's a way not to pay tax on it.
Which sounds like a good idea.
Yeah. So a QCD to go with your RMD. So that's your qualified charitable distribution. So that's where you send the money directly from your IRA to the charity of your choice. And
you don't touch it.
Sorry.
Oh, bless you. Yeah, so, like, for instance, if you are somebody that traditionally gives money to the church every week, and let's say you give $100 a week, so that's $5,200 in a year, and now comes time to do your RMD, and you think, well, I got to take $6,000 out of my RMD. Well, you can talk to your banker or broker and say, I want this $5,200 that I would have given per week in a one lump sum to go to St. Mary's Church or St. John's Church or 8 Days of Hope or whatever your charity of choice is. And they'll take that money and send it directly to that charity. And then when they give you the 1099 form at the end of the year, since they gave $5,200, all that's going to be taxable is the difference between that and what you took out. In this case, if you took out $6,000, only $800 of it would be taxable because the money that you would have given anyway, you've done it in a smarter way.
Right. Yep.
But you got a plan.
You definitely got a plan. Yes, and on our website now we do have the RMD calculator up under retirement services. So if you're wondering how much do I have to take out, when you can go right there, plug in the number, your age, and it will tell you what your distribution is. So.
And I will tell you, with the change that's just happening under tax law, what you thought in the past is been substantially changed.
Yes.
So you want to make sure it's, a lot of times doing taxes is like playing a game of pool. If you hit the white ball from the side pocket to hit the one at the end and then it ricochets over, that's how it kind of is. This causes that to happen, and you want to make sure that you're abreast of everything, and probably your financial planner is going to be learning all these changes. So if you want to make sure you contact us at egtax.com at 632-7886, or listen to Ask the Tax Lady every Saturday here on WBEN. We're going to get you so that you have at least an operating idea of what's happening with these changes.
Exactly. And going back to this, what happens if Sam doesn't take his RMD out, Esther?
Well, then he pays a penalty because it's required. And really, they've chopped down these penalties.
Yeah.
They used to be 50% of the amount you didn't take out, and now it's 25% of the amount you didn't take out. But if you have a good reason and you fix it right away, then the penalty goes down to 10%, right?
Right.
So the required minimum distribution is a requirement because they have been waiting your whole life to have you take that money out. And now with the change in the tax law, they're probably not going to get it anyway.
Yeah. Yeah.
I mean, it's true.
Yep. Yes.
So,
yes.
okay, what else we got? We got any other emails here?
Yep. Michelle writes in, I'm living with my future husband, and I have 2 children from my first marriage. I do not work, so he supports all of us. He makes wages of $80,000 a year, and we struggle to stay afloat financially. My friend says he can claim the kids. Can he?
Okay, well, he can claim the kids as dependents, other dependents,
Yep.
but can he claim the kids as his children?
No.
Right.
Not till they
But
say
what-
I do.
Right, but here it is, the middle of the year, right?
Yep.
So if he doesn't get claim the kids as his qualified children, and their other dependents, all he's going to get is $500 for mom, $500 for the kid 1, and $500 for kid 2, right?
Right.
Or they'll say $1,500. But what happens if the two of them say, let's get married on New Year's Eve on December 31st at 11 o'clock?
Well-
What happens then?
Well, then his standard deduction, which is roughly, we'll just say $14,000, will jump up to $28,000. So that will save him a lot of money. It will reduce the tax brackets, and then also the children now become his children.
Right.
So he gets if they're under age 17, he would get a $2,000 credit per
Oh,
child.
no, wait, they changed the law. So we have
It could
22
be
to 25.
Yep.
So that's even more.
Yeah. Yeah. So
So basically, he goes from saving $1,500 to saving about $5,000.
easily. Yep.
Right. So whenever you're living, and back in the day, if my dad thought I was going to live with somebody without the benefit of marriage, he would have taken me to the woodshed. But now it's kind of like normal. But still, the IRS doesn't consider children that you're supporting, even though you're acting like the stepdad, unless you have that piece of paper, as qualified children. So you lose the $2,200 to $2,500 child tax credit.
Okay.
And all you can take is the other dependent credit, which is $500. And the child tax credit has a refundable feature as well.
Right. Well,
So it is really beneficial. If you like her, put a ring on it.
Right. Or how about this? You know me, I like to throw a monkey wrench into these questions.
Uh-huh.
What if she went and got a job that paid $10,000 a year?
Well, then that changes everything.
Yeah.
Because in that case, she could claim the children. She'd get the child tax credit and a refundable child tax credit and an earned income credit.
Right. So she would get about $13,000 by making $10,000.
That's correct.
So
That's correct. And that's why the bumper pool thing is exactly, it's like, sure, if she's sitting home and she's not working and she's being Mrs. Housewife, but she's not without the benefit of marriage, they're not going to give you all these tax breaks. But he makes enough money that if the kids are legally his stepchildren, then he's going to only save the $2,200 to $2,500 per kid, right?
Yes.
But if they don't stay married because they don't want to get married, and she gets a part-time job, she gets to claim those kids and her tax return, and she gets the earned income credit and refundable child tax credit. She makes out like a bandit.
Yep.
And again,
Definitely.
that's where ignorance of the law is not a good thing.
Exactly.
And that's why we want to help you. And so just give EG Tax a call. Go to our website at egtax.com. We want to help you. We got a time for a short one, Chris?
Sure. I want to help my son and future daughter-in-law to buy a house. I want to give them $50,000. How much tax would they have to pay on this?
Oh, that's an easy one. You can. What is that, Chris?
Zero.
Right,
Nothing.
because anytime you get a gift, That's tax-free. What about her? What if she took the $50,000 out of her pension?
Right. Well, then Jesse would be paying tax on that $50,000, and it could help. It could potentially increase the taxability of her Social Security. So yeah, she's got to do planning. She should definitely give us a call so we.
And
can,
if she's under the age of 59 and a half, she'd be subject to a penalty.
Oh my gosh, yes.
Right? So it could be devastating. Even though your kids would get it tax-free, you might have to pay taxes. So make sure that if you're doing gifts, you take it out of a non-taxable source. I'm Esther Golias, the tax lady from EG Tax. Thanks for listening. If you need the best tax help, give EG Tax a call at 632-7886. Go to our website at egtax.com. With Chris Fabian, have a great weekend. Thanks for listening.